Hello and welcome to the new employee orientation benefits part 1 insurance. My name is Samuel Ensenat and I am part of the benefits team. Be sure to follow along with me with your new employee benefits guide as the one that's appearing on your screen right now. So let's get started with People First. People First is our insurance administrator that the state of Florida has contracted to be our administrator to handle insurance enrollment, to determine eligible dependents, and to process changes throughout the enrollment process for plans as well as dependents. And if you are leaving the university, People First will be involved with the COBRA insurance continuation. For that reason, it is important to get your People First ID number. Your People First ID number will be available the day after your first day of work, unless you are still requiring to submit your Social Security number to the UCF system. Once the Social Security number is loaded into this UCF system, then your People First ID number would be generated. With that People First ID number, you are able to enroll in your insurance by either logging into the online portal, which is listed on this screen, the online portal website, or you can call the service center Monday through Friday from 8 a.m. to 6 p.m. at the service center number on the screen. The magic number is 60. 60 is the number of days in which you have to enroll in your insurance during this initial new hire period. So 60 days from your hire date. Employees in a regular position may elect health insurance to begin the month after they are hired if the election is completed during their month of hire. This is called an early effective date. So that is the earliest your health insurance can begin. When your insurance goes into effect, that is when your insurance cards are mailed out. Premiums are deducted a month in advance. For example, if the deduction takes place now in March, then they're paying for coverage in April. If you elect to have the early health insurance effective date, you may be contacted by a benefits section regarding the possible double deduction, depending on the timing of your election and the payroll processing cycle. Rehire transfers and employees. You are not considered a new employee in terms of benefits enrollment through People First if you are rehired or transferring from a state university within 26 weeks, or you're rehired or transferring from another non-university state agency within 13 weeks. If you do not enroll in benefits as an eligible OPS employee when you initially were eligible, you will not be eligible to enroll if you are hired now into a regular non-OPS position unless your break in service between your OPS and regular position is greater than 26 weeks. If you are not considered a new employee, the benefits that you were previously enrolled in will be reinstated upon your rehire transfer without a qualifying status change event to cancel or change the benefits. Now let's talk about the most common dependents eligible for insurance. The first would be your spouse, and the second would be children up to the age of 26. On the year in which your child turns 26, they may remain on your insurance until the end of the calendar year. But come January 1st of the following year, People First will automatically drop them from their insurance. So make sure they have signed up for new insurance effective January 1st. Children with disabilities may be covered after the age limit if they meet certain criteria. You will need to contact People First regarding the eligible criteria and setting up children with disabilities. You may enroll an overage dependent. An overage dependent would be eligible up until the age of 30 if they meet certain criteria such as unmarried, no dependents of their own, are dependent on you for financial support, live in Florida or attend a school in another state, and have no other health insurance. However, please be advised, overage dependents are at a much higher premium on their own. Their premium is in the $700 range on top of the premium that you're already paying for yourself. Very important, if you add a dependent to your health insurance coverage, you will receive a request to provide documentation of your newly added dependent's eligibility. For more information about the eligible dependents, please visit mybenefits.myflorida.com. Making changes to your plan. So after this initial 60-day new hire window from the date of hire, you will have two other opportunities. You may have two other opportunities to make changes to your benefits. One would be if you fall under a qualifying status change events. Events such as marriage, divorce, birth of a child, or your spouse gaining or losing insurance coverage elsewhere would trigger an event that would allow you to make changes to your insurance. Of course, according to the type of change that's taking place. Employees have 60 days from the effective date of the event to contact PeopleVerse. So an example, if marriage is your qualifying event, on your wedding day, you have 60 days from your wedding day to make the change to your insurance. The other time in which you can make changes to your insurance is during open enrollment. Open enrollment takes place one time a year, and it is determined by PeopleVerse. The time period in which open enrollment takes place is usually in the fall, and changes made during the fall go into effect January 1st of the following year. If you do not make changes during open enrollment, all of your elections will continue on the new plan year. So let's start talking about the health insurance plans themselves. We'll start with talking about the coverage levels and monthly premiums. So there are individual coverage, also known as single coverage, and then there is family coverage. If you have a dependent, then the only option to cover that dependent is through family coverage. The family premium will be the same amount, whether it's family coverage for one dependent or 10 dependents, it'll be the same amount. You will notice on this slide there is also something called a spouse program. The spouse program is a discounted family coverage. If you and your spouse are employed by the state agency or by a public university that participates in the state group insurance program, you can participate in the spouse program and pay less for your family health insurance at a reduced premium of $15 a month or $30 for the entire household. Now let's talk about the health insurance plans in more specific. There are the standard plans. For the standard plans, there is an HMO and a PPO plan. With the standard HMO, the plan is broken down by a range of different companies to choose from, depending on the county that you live in. On page 9 of your guide, it goes into more details of which are the HMO companies that are assigned to your county that you live in. Since the University of Central Florida is your working county will also determine the HMO that you also have access to. Since UCF is in Orange County, you will have the option to choose the Aetna plan since it is Orange County HMO. But you'll also have, depending on the county you live in, an additional option at times. When it comes to the PPO, there's just one company to choose from, and that is Florida Blue, also known as Blue Cross Blue Shield. The main difference between the HMO and the PPO is as follows. The coverage level for the HMO is pretty straightforward. It is just in-network coverage. There is no coverage outside of the network. So any services taken outside of the network will be completely paid out of your pocket. There will be no insurance coverage. There is an exception in terms of emergency situations where you will be able to go to the emergency room even if the hospital is out of network. Whereas with the PPO, the coverage will be better coverage in network, but for out of network, there will be a coverage of some sort. There is still contributions that the PPO will provide for your insurance. Now, the HMO is a little more straightforward in terms of what you have to pay, what your employee responsibilities are for the medical expenses. You only have to do a copay, which is a simple flat fee. Depending on the service, that fee will be a simple lower amount, or if it's for a big service like a hospitalization, then you'll just pay a flat fee of $250. Whereas with the PPO, there is a copay for simple services like a visit to the doctor or visit to the specialist, where you pay a simple flat fee for that visit. But when it comes to more complex medical procedures like hospitalizations and surgeries, you'll have a different cost structure in which you will pay a deductible, which is the initial amount of money that you pay up front before any insurance kicks in. And then you'll have what's called co-insurance, which is a splitting of the bill. It could be a range of 80-20, where you're paying 20% of the bill and the insurance company is paying 80% of the bill, or 60-40, where again you're paying 40% and the insurance company is paying 60%. You will pay that amount until you reach the out-of-pocket maximum. For a great breakdown of the copays, deductibles, and co-insurance, you'll want to go to see the table on page 10 of your guide. These insurances, regardless of whether it's the HMO or the PPO, are open access insurances, meaning you can go directly to a specialist, of course with the HMO as long as they're a network, without having to get a referral from your primary doctor. Now let's talk about the high deductible HMO and PPO plan. The company providers are the same as the company providers for the HMO. For the standard plans. In that, the company providers are going to be based on the county that you live in for the HMO, and then for the PPO, it is going to be Florida Blue Cross Blue Shield. Now, the coverage is also going to be the same network. So for the HMO, it's going to be only in network. There will be no coverage out of network unless it's an emergency. Whereas with the high deductible PPO, you'll have better coverage for in-network coverage, but you will still get coverage out of network. The major difference between a higher deductible and the standard plans is the employee responsibilities when it comes to the bill. There is no such thing as a copay for either the HMO or the PPO in the high deductible plan. All medical expenses are first paid by the high deductible. You will pay that amount first before any insurance kicks in. Once you've paid your deductible, then the co-insurance kicks in, where you will be splitting the bill with the insurance company until you reach your out-of-pocket maximum. Some of the benefits of the high deductible plan are as follows. The premium, as we saw a couple slides ago, is lower for the high deductible, the monthly premium. The out-of-pocket maximum is going to be lower. And as you'll notice on the bottom of this slide, the high deductible plans have a health savings account attached to them to help assist you with the payment of the high deductible. We will go into more detail about the high deductible in the upcoming slide, but you can see from this slide that UCF will make a contribution of up to $500 annually for individual coverage, or $1,000 annually for the family coverage. Before we talk more about the health savings account, we will talk about the prescription drug plans. The prescription drug plans are attached to either health insurance option that you choose, whether it's the standard HMO or PPO or the high deductible HMO or PPO. This prescription drug plan is included with that health insurance. The plan is called CVS Caremark, and it will be a separate ID card that will come in the mail for you to present to your pharmacy when you are purchasing prescription drugs. You will present your health insurance card at your doctor's office, and you'll present your prescription drug card for your pharmacy. This prescription drug plan is through CVS Caremark, and although the company is CVS Caremark, it will work at all pharmacies except their number one competitor, Walgreens. This plan will not work at Walgreens. You have the option to do medication synchronization, which allows prescriptions to be synchronized so they can be refilled on the same day. This chart here is a breakdown of the costs. Of course, for the standard plans, it's a copay system. And then for the high deductible plans, it is a co-insurance, which will not kick in until after the deductible has been met. Now let's talk about the high deductible health savings account. Again, this is only available for the high deductible plan, regardless of whether it's the HMO or the PPO. You will use this pre-tax dollars to help pay for health, professional, or reimburse yourself for eligible out-of-pocket medical costs not covered by your insurance, like deductibles and co-insurance. This is just like a checking account with your bank, except the bank, in this case, will be Chard Snyder. But this checking account is, as stated earlier, only meant for medical expenses. This health savings account does not have a use it or lose it rule attached to it, so the accounts that are in that balance will carry forward year after year. A breakdown of this table is showing the UCF contributions, but you can contribute pre-tax dollars in addition to what UCF is already contributing. But it is important to note that when you are enrolling in this plan, you do need to select that you want UCF to make the health savings account contributions when you're signing up online or signing up over the phone. You may change the amount of your contributions that you make pre-tax at any time by contacting People First. Now let's talk about the Shared Savings Program. You can earn rewards through using one of the following benefits. First, there is Healthcare Blue Book, which is the equivalent of like a Trivago or Kayak service, in which you use this tool to find the best rates and the best rated medical facilities for your non-emergency surgical procedures. By using this tool, you'll be rewarded, and the website is right there. The other tool that's available to you is a bundled medical service called Surgery Plus. Each healthcare service will receive a reward. Surgery Plus, to be more in detail, is a concierge service that helps find the best doctors for the procedure. They'll give you a list of the 3 best doctors for the procedure. They will then plan your surgery and schedule your appointments, and then they will take care of the medical bills for you. And then they take care of setting up the rewards for the state of Florida. It is important to use these tools for the reason that by using these tools, you're helping yourself to get the best medical procedures done, but it also is a tool that helps keep our insurance premiums down by ensuring that the medical procedures are being performed at the best costs. For more information about the rewards themselves, you have the opportunity when you're initially enrolling in People First or calling over the phone to choose a pre-tax account for which your rewards will be credited to. You may make this selection at any time on the People First website or over the phone. And if you have a spending or savings account selection available to you, you can choose those plans, whether it's the flexible spending account, which we'll talk about in a few slides, or the health savings account, or you can default into the health reimbursement account if you do not choose between the others or have not enrolled in one of the other plans. Dental insurance. There are 4 main dental plan types available to you. Of those 4 main types, there are 11 different dental plans. The first of the 4 categories of dental is dental prepaid, also known as dental HMO, dental preferred provider organization, also known as dental PPO, and then the dental indemnity PPO network plans, and then the indemnity plans. Because there are so many dental plans to choose from, it is best to consult with your dentist to see which network they accept of the dental plans available. So let's first talk about the dental prepaid plans, also known as dental HMOs. Much like a health insurance HMO, the dental HMOs will only work in network providers. There is no coverage for out-of-network services. There is no charge for the most preventative services, like an X-ray or whatnot. And then there are no deductibles or calendar year maximums. So you just pay your copay and the insurance company takes care of the rest of the bill. You will notice that the dental plans have a more of a tier system in terms of coverage for your dependents. So you can choose to just insure you and your spouse, or just you and your children, or you can insure the entire family. One thing to be very mindful of with the dental prepaid plans is that the network is very limited for these plans. They will only work in chain dentals, franchise dentals like possibly a Greenberg or a Bright Now. Depending on the dental plan will determine which chain dentals they accept. Now let's go with the dental preferred provider organizations. These are the lower end PPOs. There is the most basic plan, which is the preventative dental PPO, and then there's the intermediate PPO, which is the standard plans. With these plans, much like a health insurance HMO, you may use any provider you want, but you will pay less when you use the in-network provider. There are no charges for in-network preventative care. It's about 20% of out-of-network, so you'll still have charges out-of-network, but none in-network. There is a deductible for basic and major care. There is something that is different from the health insurance PPO in that instead of there being an out-of-pocket maximum, there's what's somewhat the opposite, a calendar year maximum. The calendar year maximum is the maximum amount of money that the dental plan will pay for each dependent each year in the plan. You will want to review the dental charts in your handouts to get a better breakdown of the deductibles, coinsurance, and annual maximums that range from the preventative and the standard plans. It is important to also note the preventative care does not cover major dental work or orthodontia. Now we'll talk about the higher end PPO plans called the Dental Indemnity PPO plans. With these plans, you may use any dental provider, but you will pay a discounted rate with in-network providers. but the coinsurance and deductibles are the same across the board, regardless of whether it's in or out of network. You pay cost above the set dollar amount, and there is a annual maximum, but it is a higher annual maximum than the standard and preventative plans. Last but not least, there is the Indemnity plan. This plan allows you to use any dental provider. You pay first and get reimbursed a set fee. It's a scheduled amount for the covered services. There is a calendar year maximum, and the dentist fees are not negotiated by insurers, and the dentist may charge any amount they choose per procedure. We will now move on to the vision plan. The vision plan is considered a cash allowance plan. It is a plan that has both in and out of network coverage. Of course, there's better coverage in network than out of network. And much like the dental plan, it does have a tier system for your dependents. One thing to note with dental and with vision, unlike with health insurance, you will not have an early effective date for insurance coverage. There will be a 2-month waiting period from the moment you enroll for your insurance to become effective. A couple things to note about the vision plan is that it is meant to help pay for expenses like materials like your frames and lenses and contacts. In a year in which you're using the plan for frames and lenses, then the discount allowances won't apply towards contacts. So you'll want to do 1 year with frames and lenses and the next year with contacts. Another thing to note is that your health insurance will cover an eye exam if you don't take this insurance. So if you just need to do an eye exam, you don't need this vision plan to see an eye doctor for a regular eye exam. But this plan is a good plan to help pay for the materials, and also gives you a cheaper eye exam for a $10 copay. We'll now go on to talk about the flexible spending accounts. There are 3 types of flexible spending accounts. There's the healthcare flexible spending account, the limited purpose flexible spending account, and the dependent care flexible spending accounts. These plans are meant to be, they're similar to like a loan in which you set aside pre-tax dollars from your paycheck, and over the course of the year, you have until the end of that time period to use that money towards medical expenses that are eligible or be reimbursed for expenses that you've incurred during that year. The plan is a use it or lose it plan. So at the end of the deadline, if any monies that have not been used would be forfeited, which we'll go into more detail in the next slide. The bank that handles this is again Charles Snyder, and they will be submitting a debit card, a benefits card in the mail for you to use this plan. So in the chart found on this slide, you will see that we'll go plan by plan. The first plan is the healthcare FSA. It is only for employees that are not in the high deductible plan. So if you enrolled in a standard plan or you have health insurance elsewhere, you're eligible for this healthcare FSA. The eligible expenses are expenses such as a deductible, copays, medical, pharmacy, dental, vision expenses. Those would be the eligible expenses for the healthcare FSA. Whereas with the limited purpose FSA, that is the FSA that's available to employees that choose the high deductible health plan. But with the limited purpose FSA, the eligible expenses are expenses not paid by the insurance or reimbursed for any source. So examples would be dental and vision expenses. With the limited purpose and the flexible spending account for healthcare, there is a minimum amount that you can set aside, which would be $60, and a maximum amount which you could set aside, which is $2,750. With these FSAs, that amount that you have set will be immediately available to you. But over the course of the remainder of the calendar year, you will have your biweekly deductions to help pay back that amount that you have made available to you. So keep that in mind as we are in the middle of the year. If you're enrolling in this plan in the middle of the year, you only have what's left in the year to pay back that dollar amount and to use that flexible spending account. The deadline to use the funds for the healthcare and limited purpose flexible spending account is December 31st. That is the last day to submit claims, and you must submit all claims. That is the last day to incur all claims. You still have until April 15th to submit any claims that were incurred prior to December 31st. It is important to note that if you have funds remaining at the end of the plan year, a maximum of $500 will carry over to the next plan year, while any funds in excess of $500 will be forfeited. So there is at least a $500 carryover to the next year. So keep that in mind when enrolling for this plan. Now there's a third plan for the flexible spending accounts in the dependent care flexible spending account. This is for expenses such as daycare or elderly care. But this plan is different from the previous FSA accounts in that it is in a plan where you have monies deducted from your paycheck biweekly, and whatever is in your balance, whatever has been deducted to this point, is what's available to you for you to use the next month. So if you had $10 taken out this paycheck, you'll have that available for you to use towards daycare or elderly care expenses next month. For that reason, the deadlines to use the funds are different for the use it or lose it. You have a grace period of March 15th of the following year in which you signed up for this FSA to use or incur your dependent care flexible spending account. And of course, you have until April 15th to claim any claims that were incurred prior to March 15th. We're going to go ahead and watch a quick video that goes into more detail about the flexible spending accounts.
Having a solid healthcare plan to fall back on is reassuring, but when expenses that aren't covered by your health plan add up quickly, it knocks your comfort level down a few notches. With a flexible savings account, out-of-pocket healthcare expenses are covered with pre-tax dollars. That means what you contribute to your FSA is reduced from your taxable income, giving you a significant tax break. And an FSA doesn't just cover out-of-pocket healthcare expenses either. You can put money aside for daycare expenses with a dependent care FSA. So you're covered on all angles beyond healthcare. And because it's all with pre-tax dollars, you're saving yourself a pretty penny. With an FSA, your funds are available 24/7, giving you the luxury of accessing your account information, transactions, and contributions online with our mobile app or with your benefits card. For more information on signing up for your flexible savings account, contact your HR provider today.
And now we will talk about life insurance. You are automatically enrolled in a basic life insurance policy that the university is paying for. The value of this basic life insurance policy is $25,000. Because of that, you have the option to designate a beneficiary to that life insurance policy, or if you do not want the basic life insurance policy, you have the initial 60-day enrollment period from your date of hire to cancel that basic life insurance policy. You may designate a beneficiary through the guide. Has a link to the form that you can fill out. You'll also get a form in the mail from People First, or you can log into the People First portal a month after your initial hire to designate a beneficiary online. In addition to the basic life insurance policy, you can add on additional life insurance policies of your own at a cost. You can go from 1 to 7 times your salary in life insurance, optional life insurance coverage. The optional life insurance policy premiums are based on 2 factors: your age and your salary. So anytime you reach a milestone birthday, which is any birthday that ends with a 5 or a 0, or anytime you have a salary increase, you will see that your premiums will increase the month in which your birthday or salary increase takes place. You also have the option to sign up for some dependent life insurance policies, such as spouse and child life insurance. The child life insurance is for each child. The coverage is the same for each child at a value of 85 cents per month. The company that underwrites the life insurance policy is Securian Financial. And now we're going to talk about some other supplemental plans that are available to you. These plans are called income replacement plans. They provide assistance to offset lost income if you have one of these events take place. These plans do not take the place of your health insurance, as your health insurance will pay the medical costs, but as stated earlier, they just offset any lost income if one of these events take place. For example, if you were to choose the hospitalization plan, in the event that you go to the hospital, that's when that plan would go into effect and help offset lost income. The best way to enroll for these plans is first to call the companies. The phone numbers for these companies are found in your guide. The reason for calling these companies is, 1, some of these plans require underwriting, and 2, some of these plans have so many different options that talking to the company reps will help narrow down your decision. Now we're going to move on to the Gabor agency. This is separate from People First. We no longer are going to talk about insurances that are covered under People First. We've completed that part of the presentation. Now we're going to talk about some other insurances provided by the Gabor agency. The Gabor agency is the administrator that handles our long-term disability insurance plans and some additional life insurance policies. In order to enroll in these policies, you will have to contact the Gabor agency directly, and they will probably send a Gabor rep, a UCF Gabor rep, to meet with you regarding these plans. There is more information about contacting the Gabor agency in the benefits guide. So for long-term disability, there are 2 types of long-term disability. There's the short-term long-term disability, which starts off short-term and then it automatically converts to long-term disability, and then there's just the long-term disability plan. For the short-term long-term plan, it starts after 30 days of medical absence, and it will be a secondary income to help you through a catastrophic event. With the short-term long-term, after 90 days, the plan converts to the 90-day long-term plan. The 90-day long-term plan will kick in on the 91st day. The benefit begins, and it is meant to pay for the long haul. Again, it's for catastrophic events. It is a continuous income that will continue to pay you up to the age of 65 or Social Security normal retirement age. There's a chart in the benefits guide that goes into more detail about the Gabor agency and the plans for the long-term disability. We will also talk about now the life insurance policies for the Gabor agency. This chart goes over these plans in more detail. A couple things to note with these plans is that these plans are portable. The previous life insurance plans that I spoke of through People First, Securian Financial, those plans are only available while you're working for UCF, and they term after you leave. Whereas with these Gabor life insurance policies, you do have the option to continue them through a direct bill pay with the Gabor agency. Also, some of these plans are term life insurance policies in which you can lock in a rate for how much your premium is going to be, and it's kind of like a contract where it'll be a coverage plan that'll last 10, 15, 20, maybe even 30 years, depending on the plan you choose. So those are the insurances that are provided by the university. This next part is related to our leave of absence and workers' compensation department. For more details about what I'm going to read now, you'll want to contact the leave of absence department, and their information is on the bottom of this slide. Family Medical Leave Act rights and responsibilities. Employees who are out for a period greater than 10 days due to a medical reason must request a medical leave of absence. Absences cannot be counted against employees for attendance or disciplinary purposes if the employee leave of absence is designated as family medical leave. To be entitled to Family Medical Leave Act leave, the employee must be employed with the university for 1 year and have worked 1,250 hours in the 12-month period prior to their leave. Now, we've talked a lot about the different insurances provided by the university, and we know that it can seem a little bit overwhelming. So for that reason, the benefits team has provided the option for you to set up a benefits enrollment lab. Enrollment labs right now are being offered over the phone instead of in person. So in order to get that started, you can contact the main benefits phone number at 407-823-2771 or email benefits@ucf.edu, and one of the benefits coordinators will get back in touch with you to set up a telephone enrollment lab. With that, we want to welcome you to the university. Thank you for choosing UCF, and we will be coming back in a moment to talk more about retirement.